It is Wednesday, March 4th, 2020, and I wanted to provide a quick update what I believe gold miners and the market in general are up to the next few days. And I want to talk about a couple of myths that are out there, what gold actually is and how gold miners perform versus reality, because there's a few misconceptions that I want to talk about. And I also want to discuss the idea that gold miners might have put in the bottom and that they are about to start a rally. I also believe that the S&P 500 is close to rolling over again. Today we broke above 3,100, but I believe the odds are pretty good that we could see a gap down maybe tomorrow on Thursday, and then we see the next move south. And I want to talk about all that here in this presentation. So the myths that I want to put aside here about gold is that gold is not a safe haven. The week of the Salami crash that we saw just recently proved that to us. Gold is an alternative currency and it is not a safe haven. So please do not believe the hype. Do not believe it when some pundits on TV talk about gold being a safe asset. It ain't. Another misconception is that if oil prices drop, it would be good for gold mining shares, because the gold producers would then have lower income input costs, because their machinery that runs on a lot of diesel, and the lower oil goes, the lower diesel goes. It sounds beautiful on paper. Unfortunately, it is nonsense as well. It's actually the opposite. We want oil to go higher, but I will explain in the slides later on why that is. Another misconception is that gold miners are solely reliant on the price of gold. That is also not true. They are a lot higher correlated to the price of silver, and I will show evidence of that in the slides to come. And what is really reality? And the only thing that is true is that gold miners care about real interest rates, and that is two components to calculate that, and you need the level of interest rates minus the level of inflation, and then you get real interest rates. So in essence, the higher inflation, desto, that is a German word, the higher inflation, the better. The lower interest rates, the better. So we want those guys here to go down and those guys here to go up. So, but first I want to show you a couple of charts to prove to you how gold miners are correlated to gold versus silver. Here on the left I have GLD, so we see the price of gold here, and here is GDXJ. We see there is a correlation. It would be odd if there was none, but it is not really that tight of a correlation, because gold miners need more than the price of gold to go higher or to go lower for that matter. And it really becomes obvious when I show you the next slide, because there here I have SLV, I have silver, and I have GDXJ here. And just by looking at the two charts, that correlation is a lot tighter. So we need to watch how silver is behaving and how gold miners are behaving relative to the price of silver. But this one here is the important chart. And what I'm really liking about both of those charts is that we took out these two lows here. We dipped below. All the stops that were sitting below here, they got taken out, and then we reversed higher. I like that this happened in silver. The same price action we saw here in GDXJ. There were probably a bunch of stops here, just shy of all those lows. They got taken out, and now we are going higher. This is a very good sign, and I believe that this low here will hold. So that is why I am bullish on JNARC, and I want to stay long for the time being. But let's take a look at the overall market and what has happened. What is the status quo right now? What is that annoying, stupid coronavirus doing to us? So at first, Wall Street was only focusing on the supply shock because Chinese companies were not able to produce the inputs that a lot of domestic companies require. That is one part of the equation, but it is a Mickey Mouse analysis because there's a lot more to it, because there's also a demand shock. When people are afraid about their well-being, they behave differently. They don't go and buy their vehicles. They don't go out to eat at the restaurant. They don't travel as much. They simply behave differently, and that also means there is a demand shock. Demand is dropping. Supply is dropping. What does that do to the price of oil? Oil is dropping, and contrary to common belief, this is not good for gold miners, because when oil drops, inflation expectations drop. Actually, oil is the most important factor when it comes to inflation expectations. So this is not good. The only component that we currently have that is good for gold miners is that interest rates are dropping. I mean, they are crashing. That is the only thing that is good. We need inflation expectations to at least stabilize. And once they do, or once the market starts pricing it in, that the coronavirus, although it is very annoying and it is disruptive, it is temporary. At some point, we will get over it, because the more people have been infected, the more people become immune, and the more time has gone by, the closer we get to a vaccine, and the closer we get to a treatment. So this is a temporary shock. It will go away. And what is really beautiful about this setup is that we have now seen this stimulus by the Fed. We have seen them lowering interest rates by 0.5%, and they will not take that back. I don't believe they will raise it again once the coronavirus is dealt with. So that is setting up for a beautiful environment where interest rates remain low, and as soon as then inflation expectations turn up, gold miners will skyrocket higher, I believe. And once they do, they will leave many people behind, because there have been so many people burned that once they take off, they will sell into that rally, and they believe it's going to come down back again. It's going to hurt them again, and the RSI is so overbought, so they will be shorting into it, and they will get run over because they are suffering from recency bias, and they will miss most of that rally. So it is very important that we anticipate a very steep ascent, and when it happens, that we do not chicken out too quickly. And here the next chart tells us what we need. We need a few of those arrows to turn green, and this one here is the main one. Inflation expectations. We need them to at least stabilize. For that, we need oil to stabilize. And we probably need China to come back online for that to happen, so supply comes slowly back. Demand, I do not believe that we really need to see that. The market will probably anticipate that, because this is the last to come back once the epidemic or the pandemic, once it has peaked, people will be more comfortable going outside again. So I believe that we need some of those arrows here to turn green. Once they do, we have a perfect setup, because these interest rates will remain low. And if you were wondering, is there an ETF where you can check inflation expectations? Yes, there is. RINF. This is an ETF that displays inflation expectations, and recently we bottomed here, and if this low here holds, then I believe gold miners will do well. But if we drop below these lows, then gold miners are not ready to take off. So keep an eye on this guy, and also keep an eye on the price of oil. We have bottomed here a couple of days ago. So if these lows hold, then odds are pretty good that gold miners have also bottomed. Then let's take a look at the overall market and the policy reaction that we have seen. We have seen Jay Powell panic cutting interest rates by 0.5%. Today, Congress actually got something done for a change. And they're approving like an $8.3 billion emergency fund to fight the coronavirus, for accelerated vaccine development, for preventive measures, for preparation that not as many people do contract the virus. And actually there is some funds there also to support companies that have seen demand fall off a cliff, and if they need emergency funds to make payroll, that is also available. All these are very, very good signs and actually good reactions. I do not believe that it was necessary to cut interest rates, but what Congress did here, I believe, was very important. The market reaction to all of this, that we have deteriorating fundamentals short term, but then we have the stimulus coming from the Fed and the stimulus or the preventive measures coming from Congress. It is confusion. We see violent moves to the upside, violent moves to the downside, whipsaw action that is very reminiscent of the price action in Q4 2018. And we just saw this rally off the lows. 28.55 was the low on Friday, and today we went north of 3,100. I believe we are ready to roll over here again, and if we see a gap down on Thursday, I believe this will be our all clear sign to go short once again. And this is how it looks on the chart. This is the S&P 500 future, currently at 3,102. So we eclipsed that 3,100 level. That was a very important level. I do not believe that the odds are good that we keep on running to the upside here. I think the odds are pretty good that we will roll over here and that we gap lower tomorrow or maybe on Friday. But once we do, we gotta be short again, because odds are that we at least test this level here and possibly take this one out. If you want more information, you can find it on quantiyeti.com. If you have any questions for me, hit me up on StockTwits. My handle is @OptionBob.